All right, let's talk about cost volume profit analysis. One of the very first things that we learned in this session was that there are different ways that we can classify costs. The first way that we talked about, in fact, was how to identify cost by its behavior. We also talked about being able to identify cost by its traceability and also by its function. Here we're talking about more about identifying cost by behavior than anything else. There are some very important concepts in this chapter, so make sure that you really take your time to go through this, read through the material as well, because what we learn in this chapter we're really going to be using in almost each chapter and every practice assignment from here on out. So we use cost volume profit analysis to answer a lot of different questions. This is just a very, very small sample of some of the questions that we can ask and answer using CVP, such as how much does income increase if we install a new machine to reduce labor cost? Sounds like a very valid question, something that we would normally hear management discuss. What's the change in income if selling prices decline and sales volume increase? In other words, if we drop our price and we produce more, if we push more on the market at a lower price, what's that going to do to our net income? Good question. How will income change if we change the sales mix of our products or services? Maybe we'll want to sell a little bit more of B than we do A. And what sales volume is needed to earn a target income. I know what I'm doing. I know how I'm going to spend money. I know how I'm going to make money. So how much do we need to sell if we want to earn $100,000? Now, identifying cost by behavior, this is one of those classifications that we learned all the way back in chapter 14, is that cost can either be viewed as fixed or variable. And this gives us a relation of total fixed and variable cost to volume. If you look at this blue line here, this is going to be your fixed cost. Set at 32,000 fixed cost. Fixed costs do not change in relation to an activity. So no matter how many in volume you produce, fixed cost is going to stay the same. Sales is obviously zero at zero sales. And so variable cost is zero as well, because at zero activity, variable cost is also zero. And that's because variable costs rely on sales activity itself. This is variable cost starting up. It goes up usually in proportion to sales. They're not showing us sales here, but then they're giving us this green line showing us mixed cost. And mixed cost really is variable plus fixed. Well, you see that it has the exact same slope as variable cost, but it starts at fixed cost. Okay, so that feels like that makes sense. Obviously, total cost is fixed cost plus variable cost at any level of activity. This one gives you a relation of unit fixed and unit variable cost to volume. So notice here that this says cost, but this says cost per unit. And with this graph, fixed cost starts up here and kind of comes down at this weird curvilinear slope. So does total cost, but look at variable cost. It stays the same. What's the difference here? Well, it's kind of a trick on your mind because you're like, wow, how can they be this different? This is cost per unit. So how much does 1 unit cost me when I sell 1 unit? Well, it costs me $20. How much does 1 unit cost me when I sell 200 units? Each unit still costs me $20. How much does each unit cost when I sell 800? Well, each unit still costs $20. So that's why this is flat, because now this is cost per unit and the volume for units. But why this fixed cost? Why is this changed like this? Maybe we would understand it better if it went down at a straight angle instead of this curve. Well, the best way to explain this, if you'll just stop and pause, think with me for a second. Let's say you have your wireless telephone bill. Let's say you have a lot of kids like me, so your wireless telephone bill is really expensive, like $400 a month, which kind of makes me sick. Anyway, so let's say that you have an unlimited plan. Most of us have an unlimited plan. Your bill's $400 a month. And you could say that no matter how many calls I make, if we're thinking up here, it's going to be $400 a month. But let's say you only make one call. Now let's switch gears to here. Let's say you make one call and your bill is $400 a month. How much does that one call cost you? Well, that means that one call costs $400. But what if you make two calls? Well, now two calls cost 200 each, right? What about three calls? What about four calls? So you see that here is that for every unit of sales that we have, fixed cost is going to come down. Really, it's going to just start dropping by half, because that cost that stays the same gets spread out over more and more units to get us down to a cost per unit. All right, variable cost, obviously, it's the same graph. We kind of talked about all of it together. And mixed cost, the same. Stepwise costs are a little bit different. I'm not going to spend a lot of time on stepwise costs, but the best way that I can explain this is that I used to work in the construction industry. And we had about 60 employees, and all working in the field, and we could run about 5 crews at any time. So what would happen is that when you run 5 crews, that means you can work on 5 jobs at any one time. So and that made probably about three, 4, 5 people per job, depending. But what would happen is that if we wanted to have a 6th job going at one time, we would have to hire a whole nother set of crews. So no matter whether we had 1 job, 2 jobs, 3 jobs, 4 jobs, or 5 jobs, our labor cost was pretty much flat. It always stayed the same. But at the point we wanted to go up to a whole nother job, we were going to basically increase our flatline cost by that much at one time. So that's really the best way to explain the stepwise cost. We need to talk about relevant range, because relevant range is important when you think about fixed cost. You'll hear something like fixed costs are $10,000 within the relevant range. And what that means is our electricity, all of that stuff, the stuff that normally stays the same all the time, stays the same as long as you don't start producing too much. Just think about electricity. The more people that you put into an office environment, the more electricity you're going to start using, right? So that's what we're talking about, is that when we say the relevant range, when we talk about anything being fixed, it's fixed within that relevant range. Curvilinear cost, same thing. It's just non-linear. It doesn't have these big jumps. It kind of has these little swales in it, but really no difference at all. All right, so let's talk about measuring cost behavior. How do we measure cost behavior? And just to kind of get this going, to get your brain going down the right track, we have to think about the 2 different types of accountants that there are. There's the financial accountant, and that's the type of accounting that we learned in Principles 1. And then there's the managerial accountant, and that's the kind of accounting that we're learning about right now. Well, the financial accountants from Principles 1 only ever look at total cost. They never try to classify cost in different ways, whether they be variable or if it's fixed or if it's direct or indirect or period or product. The financial accountants do not care about that. So quite often in managerial accounting, we just get the number that is total cost. They don't tell us what's fixed, what's variable, or any of that stuff. And if I go back just a few slides, I'll have to pay for this a minute and come back forward. If I go back a few slides, remember, total cost is the addition of fixed cost and variable cost, right? Total cost always equals fixed cost plus variable cost. And all they give us to work with is total cost. So what we need to do, our objective here, is to classify total cost as either fixed or variable, because you'll see here in a little bit, it's very important that we know what's variable and what's fixed. Financial accountants are going to give us total cost. We've got to figure out what's fixed, what's variable. There's 3 different ways to do this: scatter diagrams, high-low method, and least squares regression. So we're going to talk about the scatter diagram first, and I'm just going to go ahead and qualify this right now. I think these are the dumbest, stupidest things you've ever had to learn in your life. I'm an accountant. Accountants see black and white, or maybe some people say black and red, whatever, but we see numbers. A scatter diagram is not even a good guess. Listen to this definition, right? I have to teach this to you, but I'm just telling you, I think it's dumb. It's a plot of cost data points on a graph. Okay, we kind of know what a graph is. It is almost always helpful to plot cost data to be able to observe a visual picture of the relationship between cost and activity. But let's talk about how they do this. Here's the thing. These dots are total cost. Remember that the green line was total cost? These dots are total cost at different levels of activity, right? Different levels of activity in different months. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 months, right? So this one's March. You can kind of see how it goes on. But that's total cost, right? And what happens is we're supposed to take total cost because that's the only number we have. And we're supposed to put these dots on a graph. Okay, and what's this saying? This is saying that at March, at around 25,000 units, our cost was $25,000. Okay, that's what it says. Whatever month this is, at about 30,000 units, our cost was somewhere about, I don't know, $24,000. So we're supposed to put these green dots on here. We don't have the purple line and the orange line yet. We put all these green dots on here. And then we're supposed to hold a ruler up. And we're supposed to try to get that ruler about halfway between all the dots so that we have about the same number of dots on the top as we have on the bottom. Does that even make any sense? And then we're going to take a pencil and we're going to draw a line along the ruler, and we're going to call that our estimated line of cost behavior. Okay, well, that's our estimated total cost line, right? But what are you talking about? We're just going to stare at a bunch of dots and try to guess at where this line's supposed to be? That sounds so crazy to me. And of course, at that point, if we're drawing the line there, at the point that our total cost line hits 0, well, that must be our fixed cost. So about 16,000 is our fixed cost. So we plot this stuff out. And then what we do is we try to figure out if we can see what our change in cost is at a certain place. So we look at 40,000 and we're saying that our total cost is 24. At 40,000, total cost is 24. And supposedly you can do this at any point on the line. And our fixed cost is 16. Therefore, what's this got to be? If total cost is 24 and fixed cost is 16, well, that means that this must be variable, right? This has to be variable cost at that place and time. And at where is this? At 40,000. Okay, so it's 24,000 at 40,000 at 16,000 at 0. So to find the slope, we take 8,000 over the 40,000, and that's 20 cents per unit. Really? Are you kidding me? That's why I'm like, this is the craziest thing I've ever seen. So we use the scatter diagram to figure out that variable cost is 20 cents per unit. And you'll never, ever, ever see me ask you to do this on a test because I think that's the dumbest thing ever. Instead, what accountants really like is the high-low method because it just seems so much more scientific. It seems so much more real because we're looking at real numbers. Okay, so we look at relationships between units and the total cost at those places. All we're really going to do, folks, is we're going to take an average, kind of an average. So what we're going to do is we're going to try to find the high and the low. So we're going to use two levels of activity. We're going to compute the variable cost per unit and the total fixed cost per unit. Let's look at what it says. It says that our high activity level is in October and our low activity level is in February. Let's look back at that graph and see if that's right. So here it is. In October, that seems like the highest number. In February, certainly looks like the lowest number. So we're finding our high, we're finding our low, and then we're going to compare cost at those 2 points, at the high and the low. Let's look at that formula again. So at the high, our cost is 29,000. At the low, it's 20,500. We do the same kind of math, but we're using real numbers this time, right? So we find that between the high and low, our change in cost is 8,500, and our change in units between high and low is 50,000. And when we do that math, we say that it must be 17 cents per unit. Okay, so now let's continue the problem. 17 cents per unit represents our variable cost. Do you remember what it was in the scatter diagram? It was 20 cents per unit, right? So you could do the rest of this the same way. I just like high-low better because it seems like it's a little bit more real. We know that at the high point, total cost is $29,000. There it is. And that total cost equals fixed cost plus variable cost. Well, how do we ever figure out the total variable cost? If it's 17 cents per unit and we did 67,500 units, that's 11,475. I just do that math, right? 17 cents per unit. If I did 67,500 units, that makes sense. Okay, so now it's just algebra, right? 29,000 equals fixed cost or some variable plus 11,475 means that we take 29,000 minus 11,475 and fixed cost must be 17,525. Okay, so that's how we're going to do it. It just seems so much better. Could you do it at the low? Absolutely. You could basically change the formula around to say that 20,500 equals fixed cost plus 17 cents per unit times 17,500. And no matter what, you're going to get this exact same number. Guaranteed, you're going to get the exact same number. Okay, the third way to do this was least squares regression. Lucky for you is that this is an advanced accounting concept. There's really nothing else to look at about least squares regression other than this side. It takes really usually a spreadsheet or some advanced type of program that's going to run a sample of data through this this crazy kind of formula and try to find a random variable and get it. But it's still even going to be a little bit closer than even maybe the high-low and the scatter diagram. Here's the difference in between these cost methods. Scatter diagram said that fixed cost was 16 at 20 cents per unit for variable. Our method, the one I like, 17,525 and 17 cents per unit variable, and least squares regression came somewhere in between there, maybe a little bit more towards the scatter diagram than it was towards the high-low, but it's there, without a doubt. All right, so now, knowing that we can figure out variable cost and fixed cost to come up with total cost, now we really need to go ahead and define a few things. And this one slide right here is probably the most important slide that you're going to see in the entire session in all of Accounting 212, because you really need to understand contribution margin. Contribution margin is just used to calculate so many different things that gives us really, really, really good information. And you got to remember who we're providing this information to, right? In managerial accounting, we're providing this information to management, to internal users, so that they can make better decisions about how they run the company. So let's make sure that we can understand contribution margin. Very, very simply put, and if you need to write up a flashcard, I suggest you do it. It's going to be sales minus variable cost equals contribution margin. You could almost relate this if you remember the formula. I know many of you don't remember it from 211, but if you remember the formula for gross profit, what was that formula? It was sales minus cost of goods sold equals gross profit. They kind of look and act the same, okay? But what we're doing for contribution margin is we're saying sales minus variable cost equals contribution margin. Now, this could be total sales, total variable cost equals total contribution margin, or it could be sales per unit minus variable cost per unit equals contribution margin per unit. I don't care how you want to look at it. It's all going to be the same thing, okay? So what's happening here, right? They made it nice and easy for us. What's the percentage of variable cost to sales? 70%, right? What's the percentage of contribution margin to sales? 30%, right? And it's good to know that, because in order to find the contribution margin ratio, we can quickly see that if we take the contribution margin divided by sales, there it is in the formula, contribution margin divided by sales, we're going to get this number called the contribution margin ratio. So already we know how to calculate two things, right? We can calculate the contribution margin per unit, and we can calculate the contribution margin ratio. Two very important things to know for this course. Because once we know how to deal with the contribution margin, we can start making some decisions, right? We can start providing information that's going to help people. One of the first things that we want to teach you about is how to do a break-even analysis, or how to find the break-even point. The break-even point is that place in which we make zero net income, right? because that means that we've had enough sales to pay off all of our expenses, and we come out at a zero income, but we haven't lost any money either. Why do we want to know that? Well, because you don't want to make less sales than that, because if you make any less than break-even sales, you're going to be at a loss. Also important because if you make more than break-even sales, you're in a profit, right? So that's why we always want to know what break-even point. It tells us what our minimum sales number really needs to be before we start making a loss. So let's kind of look at this. How do we find the break-even point in units? That's the number of units that we need to sell. How many units do we need to sell? Well, what we need to do is in order to find this, all we have to do is take fixed cost and divide it by the contribution margin per unit. In this example, fixed cost is $24,000, and we saw in the previous slide that contribution margin per unit was $30. So if we take $24,000 divided by $30 per unit, it says that in order to break even, to get net income equal to zero, we need to sell 800 units. Okay? How do we find break-even point in dollars? In this one, we use contribution margin per unit. In this one, we still start with fixed cost, but we're going to use the contribution margin ratio. Without going back to another slide, do you remember how to figure out the contribution margin ratio? You take the contribution margin per unit, that's $30, and divide it by the selling price per unit of 100. 30 divided by 100 is 30%. So we're going to take fixed cost of $24,000 divided by 30%, change that to a decimal, and it says that we need to sell $80,000 worth of stuff in order to break even. So we must be selling them for what? $100 a unit, right? If we're selling 800 units, and we have to have 80,000 in sales, we must be selling for $100 per unit. And that's true, right? If I go back, you can see, there it is. I'm selling for $100 per unit. Okay, $100 per unit. All right. What if we wanted to compute the margin of safety? And the margin of safety is basically just this place that we want to be, right? It's where we know that we're going to have a profit. We want a margin of safety of 20%. Well, that's just if we expect sales to be 100,000 and we take it away from breaking even sales, divide that again by our expected sales, it says that our margin of safety is going to be 20%. Okay. So, how do we prepare a CVP chart? This is a cost volume profit chart. And while accountants love numbers, the people that we provide information to don't always see numbers like Neo in the Matrix, right? It's just the truth. They like to see these pretty charts and graphs. But it's very, very simple to do. We have our dollars over here, right? This is going to represent cost dollars, and this is the volume of number of units. Okay, we're going to plot sales. So this is total dollars, whether it's sales or cost. I got to back up a little bit there. So we're going to plot sales, right? And you'll see if we sell them for $100 per unit, if we sell 200 units, that's $20,000, right? If we sell 600 units at $100 a piece, that's $60,000 in sales. You can see that that's all working out on the graph. 1,200 units, $100 a unit, $120,000. And then we're going to plot our fixed cost line. Fixed cost is $24,000 within the relevant range. It's always going to stay the same at $24,000. And therefore, we should be able to kind of figure out if we know what our variable cost per unit is, right? What was variable cost per unit? Does anybody remember? It was $70 a piece, right? So let's just think about that for a second. $70 a piece, 200 units, right? We can calculate that, and then when we add in the fixed cost of $24,000, we should get somewhere just shy of $40,000. We could plot it if we wanted to, and of course that's probably the best way to get total cost, or you could figure out the slope of the line if you know how to do that geometrically, start it here and graph it up. What does it all mean though? It means that anything between the two lines past the break-even point is where they intersect, you're at a loss, and anything above break-even, you're in a profit. I also want you to notice this. Break-even point is that place where all cost equals sales, right? We know how to do net income. It's sales minus expenses equals net income. So at the place where your sales are equal to your cost, that's where you're at break even. That's where you make no money. People who see these obviously can decipher it a little bit better than they can a bunch of numbers. Okay, does this help us work with changes in estimates? So they're not showing us the original. Remember, our original was, oh, here it is. Here's the original. 100 was our selling price, 70 was our variable cost, total fixed cost of 24. But what if we're optimistic? We think we can do it at 105, variable cost of 68 and fixed cost of 21, or if we're pessimistic. What does it mean? It just means that we can change it around if we need to. This one, we're taking a revised break-even point. We're using the same fixed cost, and we're going to divide that by a different contribution margin of 35, and it tells us that we have to do 686. So we can monkey around with this thing all we want so that we can give what-if scenarios to the powers that be. We can say, look, if you change your price a little bit here, or if we can cut costs and change variable costs, or if we can change fixed costs, we can start showing what the different impacts of that's going to be to the people who are trying to make the decisions. And we're providing them with excellent information when we do that. How do we apply CVP? Again, you just really need to remember this. If you didn't get me saying it before, get it now. You need to understand contribution margin is sales minus variable cost equals contribution margin. Well, how do we get to net income? It's sales minus total cost. The only cost we're missing at this point is fixed cost. So if we take contribution margin minus fixed cost, you have our pre-tax income. Can we use contribution margin to look at a contribution margin style income statement? Absolutely so. So if we know our selling price and our variable cost, and we say, what happens if we sell 1,500 units? Well, if I'm selling 1,500 units at 100 a piece, that's 150,000. And if they cost me $70 a piece, times 1,500, my variable costs are 105. Okay, that gives me a contribution margin of 45. My fixed cost never changes. It's 24,000. I'm going to have a net income of $21,000. It's that simple. It really doesn't change at all. This here just shows you what it looks like once you consider a 25% tax. So it's the same $21,000. We just take a 25% tax rate off of there to get net income after tax. Okay? Very, very important that you understand this formula and the difference between variable cost and fixed cost, and that these two things added together equals total cost. All right, what if we said, hey, what's it going to take? How much do we have to sell in dollars in order to earn a specific income? Let's say we wanted to earn a $12,000 net income. Okay, it's just a different formula. It's not even really different. We just add a piece to it. It's fixed cost divided by contribution margin ratio, but we're just going to add in our target income of $12,000. Here's what it is. It says that we have to sell $120,000. Now we don't have to sell $80,000. We have to sell $120,000 worth of stuff in order to get there. Dollar sales at a target income. What about unit sales at a target income? Still fixed costs, still add in target income, but we're just going to do the contribution margin per unit. This is still the break-even formula. All we're doing is saying, but what if we want to make this much income? You can put 50,000 here, and it would tell you exactly how many units you need to sell. Excellent information. It's awesome when you can sit in front of your boss who has no idea what he's doing in any kind of accounting, and you can just start rattling off, oh, if you want to make $12,000, you got to sell 1,200 units. And he's like, gosh, how do you do that? Well, it's because you took my class and you know how to compute these things. So this is just computing sales for a target income. This just shows you how that ends up working out and the fact that it works that way. Why? Because once you do that additional $12,000, you change the number of units and it still works out the same way. All right, sensitivity analysis, kind of the same thing. Basically, if we wanted to do revised break-even point in dollars, if we're going to take a revised fixed cost, revised contribution margin ratio, sensitivity analysis is another way of saying what if. What if this happens? What if fixed cost goes up? What if our contribution margin changes? What's it going to look like? What do we have to do? Last but certainly not least, I want to talk to you about a multi-product break-even point. And that's really, I just want to bring it up because we don't always sell just one type of widget, right? Most companies sell multiple things. So what are you going to do? Are you going to try to find a break-even point for every different type of thing that you sell? And the answer is absolutely not. I mean, that would just be way, way, way too time-consuming. But not only that, how do you ever figure out for the fact that you sell more of item A than you do of item B, and maybe you sell even more of C? So there's a way that we can do that to compute multi-product break-even. We modify it to its composite unit based on its sales mix. So we're going to find the contribution margin for a composite unit, and then we're going to multiply that back out by the sales mix. Sales mix is just the ratio of volumes of the different products. We have a very simple example to do that with. You'll see that the formula is still the same. It's fixed cost divided by contribution margin per unit. We're just going to slide the word composite in there. So here's the example. Best way to show you is through example. We're talking about hair today. They offer 3 cuts. Their annual fixed costs are $192,000. That's good. We know that now. Compute the break-even point in composite units and the number of units for each haircut at the given sales mix. So let's just look at what they've got here. So they have 3 different types of haircuts. They have a basic cut, ultra cut, and the budget cut. Okay, and then you'll see that for every 4 basic cuts, they typically do 2 ultra cuts and only 1 budget cut. That's because nobody wants that ratchet budget cut, right? They're going to come out looking like they shaved around a bowl on their head or something. So for again, one more time, for every 4 basic cuts, they're going to do 2 ultra cuts and 1 budget cut. And you see the selling price and the variable cost of each, which gives you the contribution margin for 3 of those different cuts. So this doesn't change. We figured out the contribution margin for each of the 3 different types of haircuts. But what we're adding in here now is that we're dealing with this sales mix ratio. So what I'm just going to tell you right now before we even go there is that we need to find the composite selling price and the composite variable cost in order to get to the composite unit contribution. Question is, how do we do that, right? Let's keep on going. So here's the composite unit selling price. All we're going to do is take the selling price of each one of those types of cuts and multiply it by the sales mix ratio. Simple enough. I mean, that's pretty simple math. Just take the selling price multiplied by the sales mix ratio to get the selling price per cut, and then we're just going to add them together, 80 plus 64 plus 16, to say that the total selling price per composite unit is 160. We're getting it down into this kind of like-kind thing. We do the same thing for variable costs. We take the variable cost for each type, multiply it by the sales mix ratio, get selling, they've got this wrong. This is variable price per cut. To get the 52, 36, and 8, add them all up together and we get a $96 variable cost per composite unit. Okay, so what do we know now? Well, now if we have our composite unit selling price and our composite unit variable cost, here they are, we know that price minus cost gives us contribution margin. This must be our contribution margin per composite unit, 64. Okay. What's break even? Well, break even is fixed cost divided by contribution margin per unit. Okay, but now it's per composite unit. Fixed costs don't change. They're always the same. They told us it was $192,000, and if we divide that by our composite contribution margin of 64, that says that our break-even point in composite units is 3,000 units. That's 3,000 units, folks, of all of the types of haircuts, right? The basic, the ultra, and the budget. 3,000 for all of them put together. That's what we know. We have to do 3,000 total cuts. Well, how do we ever figure out how many haircuts that really is? We multiply that 3,000 by our sales mix. 3,000 by 4 is 12,000 basic haircuts. 3 times 2 is 6,000 ultras. 3,000 budget is still 3,000 budget haircuts. That's 21,000 haircuts total. Does it work out? It absolutely does. Look at what happens. Here's my basic. 240 minus 156,000 for variable cost. When we multiply it back out, it's 84,000 contribution. I get the same thing for ultra. 192 minus 108 is 84. There's my budget, 48 minus the 24. Using exactly what we figured out, it's 24,000. Take the whole 480,000 in sales, there it is, minus the 288,000 in variable cost, and if that gives us 192,000 contribution margin, and it's exactly what fixed cost is. And that's exactly break even. When contribution margin is equal to fixed cost, we have a net income of 0. So the theory works. The way we did it completely worked it out, and we can prove it right there. Okay, multi-product break even income statement. Don't spend a lot of time thinking about this. You might need to know what it is when you do the test, but probably not much in the way of working out problems on that. And that is going to be the end of chapter 18.